Now speaking, Kylie Rollins, Vice President, Investor Relations, Dave Kimball, Chief Executive Officer of Ulta Beauty, and Scott Settersten, Chief Financial Officer, hosted a conference call to discuss the company's financial and operational results for the first quarter of fiscal 2023. They reminded the audience that any forward-looking statements made during the call are subject to numerous risks and uncertainties that are described in detail in the company's filings with the SEC. They concluded the call by asking that participants limit their questions to one so they could accommodate as many questions as possible within the hour-long call. Now speaking, Dave Kimball, Chief Executive Officer. Our loyalty program continues to be a competitive differentiator and an important part of our successful strategies. In summary, we are off to a good start in fiscal 2023. We delivered strong results while continuing to invest in our transformational agenda, and we are confident that our investments will drive long-term growth. Ulta Beauty reported net sales increased 12.3% to $2.6 billion and comparable sales increased 9.3%. Operating margin was 16.8% of sales and diluted EPS increased 9.2% to $6.88 per share. Store traffic and member growth were strong and the company experienced growth across key categories. Consumers showed a willingness to splurge on beauty care products due to its emotional connection to self-care. Skincare had the highest growth, driven by newness, engaging social media content, and performance through 21 days of beauty and spring haul. Fragrance and bath delivered low double-digit growth due to newness from Ariana Grande, Carolina Herrera, and Valentino. Makeup achieved high single-digit growth due to soft bronzing, glossy lips, expressive eyes, and nails. Hair category was flat for the quarter due to growth in hair care products and color offset by lower demand for tools. Services business also experienced double-digit comp growth, driven by cut and style, blowouts, and makeup services. Inventory shrink was an issue this quarter and the company invested in fixtures, training, support structures, and increased staffing and security to address organized retail crime. To further expand their assortment, the company launched Luxury at Ulta Beauty, certified brands, and a Conscious Beauty Essential Sample Kit. They also upgraded their digital store, introduced same-day delivery, and opened 4 Ulta Beauty shops with Target. The loyalty program had 41 million active members and increased visibility, personalized reminders, and incentives drove growth of Diamond and Platinum members. Now speaking, Scott Settersten, Chief Financial Officer. Summary, Ulta Beauty reported first quarter results in line with expectations, with net sales up 12.3% and comp sales up 9.3%. Average ticket was down 1.5%, but offset by higher units per transaction and price increases. Gross margin was slightly down due to higher inventory shrink, lower merchandise margin, and higher supply chain costs. SG&A increased 22.2%, primarily due to deleverage of store payroll and benefits, corporate overhead, and marketing expenses. Operating margin was 16.8% of sales. Net interest income was up, driven by higher average interest rates and cash balances. The company's tax rate decreased to 22.8%. Diluted GAAP earnings per share increased 9.2%. Total inventory increased 11.5%, primarily due to 41 new stores and higher purchases. Capital expenditures were $109.8 million for the quarter. Depreciation decreased to $57.9 million, due to lower store depreciation and a shift of IT investments from capital to cloud expense. Ulta repurchased 541,000 shares at a cost of $285.8 million, leaving $816 million remaining under their current repurchase authorization. For the full year, they maintain their expectations for comp sales growth and diluted earnings per share, but are updating their outlook for operating margin to between 14.5% to 14.8%. They remain optimistic about the health of the beauty category and confident in their team and growth strategies. BMO Capital Markets analyst Simeon Siegel inquired, Dave, what signs are you seeing in terms of customers trading into or out of Ulta's offerings? What's driving the decline in ticket despite higher ASP and transactions? Dave Kimball replied, Thanks, Simeon. Our business is growing rapidly and we saw that in the past few quarters. Across all income levels, growth has been strong, with roughly equivalent rates across each cohort. Traffic remains high and, while average spend per customer increased, average ticket decreased due to fewer units per transaction. Mass category products like ELF, NYX, The Ordinary, and La Roche-Posay are driving exceptional newness, making it difficult to identify the exact driver of this growth. On the prestige side, skincare is posting double-digit growth. Consumer engagement remains high, as self-care and wellness are becoming increasingly important post-pandemic. We expect some moderation in the high level of growth we've seen in the past 2 years, but remain encouraged by overall consumer engagement. Scott Settersten replied, overall, total units and spend per member are up year over year. Traffic trends in both channels are strong, particularly in brick and mortar. However, units per transaction are down, which is consistent with consumers being more selective than in the past. We are not drawing any conclusions from this trend at this time. Oppenheimer & Company analyst Rupesh Parikh inquired, what changes have you seen in the promotional environment and how do they compare to pre-pandemic 2019? Dave Kimball replied, we anticipated and planned for more promotional activity this year in line with broader competitive activity. We remain below the levels of 2019, which was a highly promotional period. Our CRM capabilities and loyalty program, with 41 million members, allow us to be strategic and pinpointed in our promotional activities. Oppenheimer & Company analyst Rupesh Parikh inquired, can you comment on the trends in services and the member utilization rate? Also, what is the percentage of consumers that make an in-store purchase after receiving a service? I believe it was around 50% previously. Has that changed? Keisha Steelman replied, yes, thank you for the question. Our salon services business was strong again in the quarter and we saw 90% of guests purchasing through our backbar events were new to the brand. Cut and color is the main driver of the services business, with health and hair loss treatments also increasing the average ticket. We hired over 950 stylists during the last quarter, which has increased capacity and made our proposition even more unique. Deutsche Bank analyst Christina Katai inquired, what return have you seen from personalized promotions, leveraging the vast data you have on members, and has your share of wallet increased with the successful high-profile brand launches and luxury assortment? Dave Kimball replied, the investments we've made in our loyalty program Ultimate Rewards have paid off, with 9% growth in members in Q1. We're seeing strong returns from our strategies to increase share of wallet and personalization, and the return is encouraging enough that we'll continue investing in data capabilities, leveraging innovation, and experimenting with new ways of engaging customers. Wells Fargo Securities analyst Ike Baruchow inquired, our loyalty program, Ultimate Rewards, is a key asset for us and our investments in it are paying off. We're proud of the 9% membership growth we saw in Q1. The strategies and plans we have to increase spend per member and share of wallet are working, particularly for Platinum and Diamond members. Our goal is to get our store-only guests to shop with us across all touch points, which increases their spend with us by 2.5 times. We've also been investing heavily in personalization and are seeing strong returns, so we'll continue to invest more in data capabilities and leveraging innovation. Scott Settersten replied, shrink was the primary factor that impacted our quarterly results. Sales and promotional activity were slightly higher than expected, but didn't have a significant effect. We've invested in strategies to mitigate shrink, however these have yet to yield any improvement. We anticipate shrink will remain a challenge for the rest of the year. Dave Kimball replied, Ike, thank you for your question. As I mentioned earlier, this is a critical issue that we are working hard to address. Despite our investments and efforts, the situation is worsening. We are taking multiple steps to tackle this problem, such as partnering with other retailers, seeking support from local leaders, law enforcement, and DAs. Additionally, I am personally heavily involved in finding solutions both for our business and across retail. Keisha will now provide more details on our actions. Keisha Steelman replied, we are making significant investments this year to increase our presence in 70% of chain stores by the end of the year, with locked fragrance cabinets as a target area. Additionally, we are increasing labor and training staff on how best to handle these types of situations. We have also invested in security guards and armed security guards at some locations, as well as partnering with landlords to discourage these groups from entering. We are taking a full court press approach and utilizing open communication with associates when incidents occur. This is a disturbing issue and we must work together to course correct it. Scott Settersten replied, Ike, to put it plainly, the shrink deleverage in the first quarter more than compensated for any fixed store cost leverage. Piper Sandler analyst Corinne Wolfmeyer inquired, how are you ensuring customer loyalty and retention rates remain strong in light of consumer pressure on their wallets? Dave Kimball replied, Corinne, our team and all 50,000 associates in our stores prioritize loyalty and retention by delivering a great experience. We've seen 9% growth in loyalty in Q1 and have multiple activities to engage and delight our guests. This includes store experiences, digital touchpoints, personalization efforts, and our unique offering of entry-level masstige to luxury products. All of this has enabled us to maintain a strong, best-in-class retention rate. Raymond James analyst Olivia Tong inquired, can you discuss the incremental promotions you are utilizing to expand and how your promo levels compare to those of your peers? Additionally, how are you leveraging loyalty members and data to promote while remaining competitive? Dave Kimball replied, the competitive environment across the beauty category is intense. We monitor promotional activity across mass, prestige and luxury and understand that our competitors are doing the same. Our investments in personalization capabilities allow us to be more targeted and reduce our promotions from 2018 and 2019 levels. We use our tools, 41 million people, CRM experience and personalization capabilities to deliver the right value at the right time. UBS analyst Michael Lasser inquired, what would be the impact on Ulta Beauty's margins if promotional activity were to go back to 2019 levels and include an increase in shrink? Dave Kimball replied, we remain confident in our long-term profitability and are on track to deliver on the 4% to 5% comp growth that we guided for this year. Our operating margin has been adjusted to reflect specific changes, but we have strategies in place to address any potential shrink issues. We delivered strong Q1 results with a 9.3% comp growth and strong EPS growth. Scott can provide more detail about Michael's question. Scott Settersten replied, in response to the question, I would say that while we have experienced some temporary headwinds and a slightly richer promotional mix, we are ready and able to react accordingly. We remain confident that our 14% to 15% margin is the right range to be in given our toolbox of levers and our long-term projects like UB Media and the digital store of the future. These initiatives will provide meaningful benefits for our stakeholders in the long run. Canaccord Genuity analyst Susan Anderson inquired, could you tell us about the performance of your health and wellness business compared to the rest of the store? Are consumers responding well to it? What are your plans for it long term? Dave Kimball replied, wellness is a key growth opportunity for us. We've seen consumers increasingly recognize the importance of beauty in their overall wellness routine, driving innovation in products specifically designed for wellness and across makeup, fragrance, and more. In May 2021, we launched our wellness shop in about 800 doors with 140 brands and 700 SKUs. Popular brands such as Love Wellness, Truly, Kitsch, Megababe, Gold, and Lemme by Kourtney Kardashian have seen high levels of engagement, and we're just getting started. We anticipate continued growth over time and are excited for the potential of this business. Morgan Stanley analyst Simeon Gutman inquired, can you provide an update on our and customer resistance, as well as the level of accrual for shrink? Scott Settersten replied, shrink has offset our store cost leverage in the first quarter. We've been trending upward with a big growth in sales, and we don't anticipate seeing any moderation this year. Unfortunately, that makes it unlikely that we'll be able to realize a gross margin benefit for the remainder of 2023. Dave Kimball replied, we had a very positive quarter and our business is showing strong indicators. We continue to drive engagement across all aspects of beauty, from newness to innovation to core products, to ensure we are delivering a great Ulta Beauty guest experience. Our long-term growth strategies remain in place and we have full confidence in our team as we look towards the future. Thank you for joining us and we look forward to speaking with you again when we report second quarter results on August 24th.